I love owning dividend stocks, and if I had to choose, obviously I would choose dividend stocks that have outperformed the S&P 500 consistently. In today's video, we're going to outline a dividend stock that has been raising their dividend for at least 25 consecutive years and has outperformed the S&P 500 over the past 5 years and the past 10 years. And if you want, you can stick with a safe dividend yield of around 2%, or you could explore an opportunity to increase your cash flow from this dividend stock from 2% up to potentially 25 or 26% every year. What's up, you guys? Welcome back to the Average Joe Investor channel. In today's video, we're talking about a dividend stock that happens to also be a dividend aristocrat and has been raising their dividend every single year now consistently for 30 consecutive years. We're talking about Caterpillar Inc., ticker symbol CAT. Caterpillar is in the industrial sector of the economy, specifically the machinery industry. They've been, like I said, raising dividends now for 30 consecutive years, which makes them a dividend aristocrat because they're also part of the S&P 500. Their current price per share is $256.45 a share, which is right in between their 52-week low of $204 and their 52-week high of $293. Their 1, 3, and 5-year revenue looks solid. 17.5% growth over the past year, 15% over the past 3 years on average, and when factoring 5 years, it's 4.56%. So we're seeing a positive trend. And you can see that their dividend growth rate is very stable. 8, 7, 9, and 8% compound annual growth rate for the past 1, 3, 5, and 10 years. Current yield 2% against a historical yield of 2.57%. So it's definitely not on a discount right now, but it is a quality dividend stock. And they offer weekly options expirations. Additionally, their annual dividend is $5.20 per share, paid in quarterly installments right now of $1.30 per share. By the way, this spreadsheet that I created for this video is available along with all of my other spreadsheets, the monthly dividend stock spreadsheet, my portfolio, and access to the Discord community. All of that's available by joining the Average Joe Investor Patreon community. Tons of value there, and I'm not sure I can guarantee it technically for legal reasons, but I feel confident that you will earn your money back within a few days, maybe the same day you sign up. If you want to learn more about joining the Average Joe Investor Patreon community, check out the link down in the description below. Okay, so Caterpillar Incorporated. Here's a little brief review. When we think of the Caterpillar brand, we think of construction equipment. We've all seen their equipment on the side of the road being used by local and federal governments to do construction work, but they're actually more than just the Cat brand or Caterpillar brand. There's also Anchor, FG Wilson, SPM Oil and Gas, Solar Turbines, Turner Powertrain, and more. You can see all these financial metrics here based on the 2022 annual report are really solid. Sales and revenue up year over year, profit per share up, adjusted profit per share, and dividends paid per share up year after year. Their sales by region is broken down with North America taking the majority of the revenue, followed by Europe and the Middle East, Asia Pacific, both around $12 to $13 billion, and then Latin America at $6.7 billion. Their business is essentially broken down into 3 different segments. You have your construction industries, resource industries, and then energy and transportation. And they have some diversification here. $25.3 billion in construction industries, $12.3 billion in resource, and then an additional $23.8 billion in energy and transportation. All of these sales are up year over year. Here's a breakdown of some of the news right now with Caterpillar. Nothing really negative or significant here. A lot of commentary regarding, Caterpillar is a great company, but whether or not it's a great price to buy right now. Here's a breakdown of their dividend safety. You can see that, again, the standard measure for dividend safety is the dividend payout ratio based on net income, which is 29.06%. I prefer to use the dividend payout ratio based on free cash flow. And as you can see down here, Caterpillar's payout ratio for the trailing 12 months based on free cash flow is 31%, and for the previous year, it is 74%. And you can see very stable and increasing free cash flow per share year over year. Now, here's how you really spike up that dividend yield. Because remember, 2%, it's not great. I mean, if you're owning quality companies and collecting a dividend, that's awesome. But how can we spike that cash flow yield? By utilizing covered calls. I've got a few screenshots from the Fidelity website Option Chain, as well as my Dividend Capture Income Calculator, which is another tool available to members of the Patreon community. We're looking at a potentially weekly covered call strategy, a bi-weekly strategy, and then down here, a monthly covered call strategy. In all these situations, we're talking about selling out of the money covered calls above the current market price. So if we're looking here at the weekly strategy and the current market price is right around 256, we look at here right around the 26 delta, which would be at 262.50 above the market price, and we collect about $150 or $150 per share for that covered call for every contract we sell. Under those circumstances, as we look right here, in the event we got assigned after just those 9 days, then we would collect in capital appreciation $642 and option income of $150, or a total amount of cash flow of $792. When you factor that into the 9 days holding period, it's a 3.09% return on capital in just 9 days. Now, our goal is not to get assigned necessarily unless that's your strategy to maximize cash flow. But let's say we wanted to hold Caterpillar long term and we could consistently utilize this type of option strategy at right around the 25-26 delta. Well, in that situation, the total annual income from options would be approximately $6,083. And the dividend income in this situation would be about $520. So total cash flow, if we could hold it all year and continue to utilize this strategy, would be about $6,603. And then when we factor in our capital requirement to own 100 shares of 25,000, this would be an annualized yield of 25.79%. Let's look at a biweekly strategy here. Same type of idea. We'd be utilizing the strike price of $265 right here, which is at the 25 delta. We collect about $176 or 1.76 per share for that option income. And if for some reason we were assigned on this option strategy after 16 days, our total cash flow would be $1,068 when you factor in both capital appreciation and option income. Return on capital in this situation would be about 4.17% if the shares got called away from you after 16 days. If we wanted to hold Caterpillar long term and collect the dividend throughout the year as well as the bi-weekly covered call income, the total cash flow for the year would be approximately $4,535, which would reflect an annualized yield, if done consistently, of 17.71%. Lastly, if we looked at a monthly strategy here and utilizing the 265 strike price or a 32 delta, you collect about $320 on a monthly basis for that option out of the money. Total cash flow, if we were assigned after 30 days and had lost our shares and had to rebuy back in, would be about 4.73% return on capital, or 57% annualized. However, if we wanted to utilize a monthly covered call strategy throughout the year and hold Caterpillar and collect that dividend, total cash flow in the situation would be about $4,413 right here, with an annualized dividend yield, or cash flow yield really, of 17.23%. So utilizing covered calls out of the money consistently on these types of dividend stocks that outperform the S&P 500, which we'll talk more about in a second, makes a lot of sense. It really spikes your cash flow yield. All right, let's talk about historical returns here. Remember, we're going to look at year-to-date, 5-year, and a 10-year history for Caterpillar. The assumption is at the beginning of the period, whether it's year-to-date, 5 years, or 10 years, where we would do a lump sum investment of $10,000 and reinvest all dividends along the way. First off, year to date, we can see here that Caterpillar is actually a little bit underperforming compared to the S&P 500 year to date. Underperformed for the majority of the first part of the year. It was about even throughout the second part of the year, and then most recently there was a drop in the stock price for Caterpillar, so it is underperforming a little bit year to date. Here's the 3-year return though, and in this situation, Caterpillar is overperforming or outperforming the S&P 500. Again, Caterpillar is in green and the S&P 500 is in red. And then lastly, a 10-year history right here. They did flip-flop around a little bit through those 10 years, but you can see that the S&P 500 is underperforming Caterpillar with respect to the 10-year history and total returns. There's a lot to like about Caterpillar, whether it's the ability to maximize that cash flow yield by utilizing covered calls, the fact that it's a dividend aristocrat with a 30-year history of raising their dividend, that there's a lot of stability in their business segments, and they continue to perform well financially. Lots to like here. Does it make sense for your portfolio? Well, it depends. I mean, if you're going to write covered calls on Caterpillar, you need to have $25,000. So that could be a barrier for some average Joe investors. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to all comments. It's my goal to respond to as many comments left on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.